Sir Isaac Newton, what does he have to say about the markets? Hi, Dean Jenkins with followmetrades.com, and I think Sir Isaac Newton has some wisdom to offer us from his own thoughts and his own experience, because not only was Sir Isaac Newton, he's widely recognized as one of the most influential scientists of all time. He's a super smart guy, contributed to mathematics, science, astronomy, physics, and even theology. But he was a trader. Little known fact, but Sir Isaac Newton tried his hand at trading, and he has some incredible wisdom to offer us. Let me tell you a short quote and a short story about Sir Isaac Newton's trading. So back in the spring of 1720, there was the hottest stock going. It was called the South Sea Company, and Sir Isaac Newton invested in it. And he started sensing, hey, this thing's getting a little bit out of hand. This thing's really growing. And here's a great quote that he said. He muttered, "I can calculate the motions of heavenly bodies, but not the madness of people, not the movement of the markets. I can't calculate that." Right? And he ended up dumping his shares of South Sea, and he pocketed 100% profit, totaling about 7,000 pounds, which, that's a lot of money in today's money. A few months later, it kept going up, and he got swept up into the enthusiasm of that, and he got back in at a much higher price, and he ended up losing 20,000 pounds, about 3 million in today's money. For the rest of his life, he forbade anyone to speak the words South Sea in his presence. So as smart as Sir Isaac Newton was, he got caught up in emotional trading, trying to guess what the market's doing and getting caught up in crowd psychology. He was trading without a plan. And that inevitably leads to real problems. Let me show you another quote from another super smart guy. So here's a great quote from Benjamin Graham, considered the father of value investing, highly influential to Warren Buffett. And Benjamin Graham said, "You must deliberately protect yourself against serious losses. You must aspire to adequate, not extraordinary performance." Basically saying, you got to control risk, you got to manage risk, and swinging for the fences may not be the best strategy, right? You should focus on solid, consistent gains, not extraordinary gains. Because if you're trying for extraordinary gains, you have to take extraordinary risk. And if you take extraordinary risk, occasionally you're going to be wrong, and it's going to be a huge setback. You're going to have huge drawdowns, maybe drain your account. So, building off of Sir Isaac Newton's experience, where he did swing for the fence and get caught up in the psychology of crowds, and from this wisdom from Benjamin Graham about, hey, let's use risk management, let's be deliberate and seek adequate, not extraordinary performance. And I think that is so applicable to today's market. So let's take a look at the chart and talk about that just a little bit. So here's a daily chart of the S&P 500, and what a year it has been. From, it really started back at the election last November, just a year ago. But if you look at the market from the open, the first trading day of January up till this year, up till the end of this year, we're sitting here at a really nice gain. So far we are at, bring over the data from CNN Money, 16.24% gain year to date. That's a really, really good year on the S&P 500. And what's notable is if you look at the opening day, it's right here. You can't probably see that exact bar. It's right here, actually. Since the opening, the very first trade of the very first day of this year, it has never once closed down. That has only happened in 10 years in the entire history of the S&P 500. So it's been a remarkable year. And it's up 16.24% year to date. That's the reality. The market's going up. You can read lots of articles and read news and talking heads and opinions about whether it's going to continue to go up or whether there's a big correction coming. Those are all opinions. Those are not reality. The market, the the price that it's trading at today and the number of shares it traded at, that's the current reality. That's the only reality in the market is price and volume. What's it going to do next? It's speculative. We can only guess what's going to happen next. But if we think about what Benjamin Graham said, we can be prepared for what's going to happen next. We can trade the current reality using risk management, seeking adequate, solid, consistent gains, but not swinging for the fences, not looking for extraordinary gains, not taking extraordinary risk. So the market's going up. We're going to trade with that. There are markets going down, segments of the market, individual stocks that are going down. So we trade the realities of the current market, always employing consistent, solid risk management so we control our losses. And so again, the S&P 500 up over 16%. Follow me trades, our stock picks are up 24.83%. And we did that by having great trade setups, trading the reality of the market, individual markets. Some stocks are clearly going up, we're trading those up. Some are clearly going down, we're staying balanced. We're managing risk. We're controlling the loss. When we're wrong about a trade, wrong about a stock, and it fails and the trade loses, we only lose a little bit. And when we win much bigger, double or 3 times the size at a minimum. So, good trade setups, trading the reality, good risk management, controlling the losses, and good trade management, getting the maximum amount of value out of each trade that we're in. So I think those are keys, and I think there's been some good wisdom. Sir Isaac Newton, his failure as a trader, basically, regardless of how smart he was, getting caught up in emotion and crowd psychology. All you got to do is look at Bitcoin and go, man, you may be feeling regret, right? Oh, I should have got in. It's up at, over $9,000 per coin, and I could. As soon as you start feeling that emotion of I'm missing it, I got to get in, or the train's, I'm just going to miss the whole thing. Boy, that's when you need to step back and think about Benjamin Graham going, hey, let's be deliberate. It's okay, we can participate in those markets, but let's protect ourselves. Let's don't take too large a position. Let's have an exit strategy. Let's use risk management, manage the trade, and seek adequate, not extraordinary performance. And adequate can be very good. We're up to, call it 25% this year. For me, that's adequate. That's really, really adequate. And year over year, that compounds and really, really adds up. So that's my little bit of a history lesson and a lecture here for the market. It's going up. And right now it looks like it's going to continue going up. There's no evidence of it turning down. Someday it'll turn down. We'll trade that. But we got to not get caught up in it, not speculate. Let's continue to trade with extraordinary discipline, risk management, trade management, and participate and get adequate performance. And let's be aware that there's big things coming up, big news. The economic calendar for this upcoming week, not that heavy. It's some normal stuff. The focus is probably going to be on tax reform, tax cut legislation, and breaking news about that in the market may be a little volatile as news comes out and it's going to pass, it's not going to pass, and so someone's for it, someone's against it. We have to kind of ride out that volatility, and again, just be careful. Don't start thinking we got to jump in or jump out, but execute our trades with a plan, with a strategy, with discipline. So again, that's my lecture for the week, and it's been working good for us. Let's take a look at a couple key markets at gold and oil before we wrap it up for this week. So here are gold futures on a daily chart, and I'm still bullish on it. And it's still taking some time to work out. This year we've had a nice move up, nice pullback, found some support at the 200 SMA. When we see it break up above the 200, or up above the Ichimoku cloud, up above 1307 again, we're going to be getting bullish on gold. And it looks like there could be another move. But again, this is a case of not jumping in too early, not speculating, trading the realities. And the realities are when it breaks above the cloud, that is pointing to a high probability of new highs, at least up to 1400. And we'll be trying to trade that. So let's take a look now at oil, another key market. So here's oil putting in, marching up in a volatile fashion all year, but really up above the 200, up above the Ichimoku cloud, up above some previous consolidation, and getting very close to the highs of the year. And looks like it's heading up. Looks still very bullish. No signs of it turning down, but we got to let this be, we got to be a little bit careful. After these impulsive moves, there's pullbacks, impulsive move, pullback. So we'll be watching this really closely. There's the Saudis and OPEC are working on their next production strategy, trying to drive price up. A lot of moving parts in the oil market. Right now it's bullish. we're going to wait for another pullback and then try to catch a leg and just participate in this. We're going to be real careful. We're going to use risk management as always. Well, that's it for this week. I sure thank you for tuning in, for listening, and I welcome and invite any feedback you have, any questions, comments you have on my thoughts here. Take care, and we'll catch you on the next update. All right, bye.